Hello, my name is Kyle McLean, and I'm a partner and senior wealth manager here with Rhame and Gorrell Wealth Management. Today, we're going to be talking about a unique tax strategy for high earners, the Backdoor Roth IRA. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Before we get started with this tax strategy, let's review IRAs at a high level. The Individual Retirement Account, or IRA for short, is a type of tax-advantaged investment account created by Congress to help individuals save for retirement. These accounts can hold many types of investments, including stocks, bonds, mutual funds, ETFs, and much more. All IRAs have tax advantages, but it's important to understand the differences between the two most common, the traditional IRA and the Roth IRA. The key differences between a traditional and a Roth IRA is the taxation. In a traditional IRA, a deduction is generally available for the contribution of assets, and all taxation is delayed or deferred until assets are withdrawn, often decades later. As an alternative, in a Roth IRA, there is no deduction available up front. Taxes are paid on the funds before they may be contributed to the account. However, distributions in retirement are generally tax-free, including on any growth that has occurred. With this in mind, who should focus on a pre-tax traditional IRA contribution, and who should focus on a Roth IRA contribution? It really boils down to the current versus future tax rate for that investor. If your current tax rate is lower than the rate at which funds would be distributed from the IRA at a later date, you'd really want to make Roth contributions, since you would rather pay your current lower tax rate and receive tax-free growth. If your current tax rate is higher than the rate at which funds would be distributed at a later date, pre-tax contributions would be better, which would encourage you to make a traditional IRA contribution if a deduction is available. There are also differences in eligibility for contributions to these types of accounts. For 2025, once a single individual has a modified adjusted gross income above $89,000, or a married individual has income exceeding $146,000, they cannot deduct a traditional IRA contribution if they also have access to a 401k plan or similar plan through their employer. For Roth IRAs, contributions are entirely disallowed for single individuals with a modified adjusted gross income over $165,000 and married individuals with a modified adjusted gross income over $246,000. The lack of a deduction for a traditional IRA contribution and a moratorium on a Roth IRA contributions above certain income levels is really what brings the Backdoor Roth IRA into play. Here's how it works. A contribution to a traditional IRA is made when the individual is above the deduction limit for traditional IRA contributions, as well as above the limit for Roth IRA contributions from an income perspective. This means that no deduction is received for the traditional IRA contribution, but the individual cannot place the money directly into their Roth IRA. Subsequently, the non-deductible funds in the traditional IRA are converted over to the Roth IRA. Although there is a moratorium on Roth IRA contributions, conversions remain allowed at any level of income. Just as funds directly contributed to a Roth IRA receive the benefits of tax deferral and tax-free distributions, so do assets that have gone through a Roth conversion from a traditional IRA into a Roth IRA. As long as future distributions are qualified under IRS rules, 100% of the Roth IRA balance will be distributed tax-free to the investor. In addition to tax-free growth and distribution, other benefits of Roth IRA assets are available. For instance, Roth IRA funds are not subject to required minimum distribution rules upon reaching the age of 73, as traditional IRA assets are. Furthermore, Roth distributions are not counted as income when income is assessed for determining things like Medicare premiums, which rise at certain levels of income. Roth distributions will also not put you over the income threshold for the 3.8% Medicare surtax on investment or earned income over certain limits. Let's consider an example for our friend Bob. Bob is married, he participates in his company 401k plan, and he has a modified adjusted gross income of over $250,000. This means that he is over the limit for income in order to make a deductible traditional IRA contribution or a Roth contribution at all. Without the Backdoor Roth IRA, the next best place for him to save would have to be his brokerage account, where gains are not tax deferred and they're taxable in the year in which they occur. The Backdoor Roth IRA allows Bob to divert funds that would otherwise be placed into his taxable brokerage account into his Roth IRA, where the gains will be tax-free in perpetuity, even though he's over the limit for a direct Roth IRA contribution. Again, Bob would make a non-deductible contribution to his traditional IRA. Subsequently, he would convert those non-deductible dollars to his Roth IRA. This is a tax-free transaction. Finally, he will enjoy the long-term, tax-advantaged growth and tax-free distribution of these Roth IRA assets. Additionally, since Bob is married, his wife can also take advantage of a spousal Backdoor Roth IRA, which doubles the available savings amount from $7,000 for somebody under the age of 50 to $14,000 as a married couple. While it's not as significant as some 401k contribution limits, the Backdoor Roth IRA amounts add up over time, and they're a nice addition to the tax optimization toolkit for those preparing for retirement. Now, let's talk a little bit about how the Backdoor Roth IRA is reported for tax purposes. As a result of the conversion, investors will receive a document called a 1099-R from their custodian that indicates a conversion or distribution from a traditional IRA has occurred. Making sure that you or your CPA correctly reflects this transaction on the Form 8606 of your tax return is critical. This is how you tell the IRS that the conversion event should not be taxed. This brings us to one of the most common pitfalls investors face when performing a Backdoor Roth IRA transaction. Again, the Form 8606 is how the investor tells the IRS what percentage of the conversion from traditional IRA to Roth IRA is tax-free. When an investor transfers $7,000 to their $0 balance traditional IRA as a non-deductible contribution, now 100% of this traditional IRA balance is non-deductible. Therefore, 100% of the conversion to Roth from the traditional IRA is subsequently tax-free. But what if they already had $7,000 in their traditional IRA that had been rolled over from a pre-tax 401k previously? Now only $7,000, or 50% of the total $14,000 balance in traditional IRA funds, is non-deductible. Therefore, on the Form 8606, this would result in 50% of the conversion from traditional IRA to Roth being tax-free. This is known as the pro rata rule. In short, the pro rata rule causes problems with Roth conversions when the investor has a prior IRA balance that originates from a pre-tax source. This can be from a pre-tax balance in a prior 401k, or simply contributions that were made to the IRA before the investor went above the deduction income limit. Carefully review your investments for pre-tax IRA balances prior to making any Roth conversion decisions. As you can tell, the Backdoor Roth IRA is a complex transaction that must take into consideration various income limitations as well as IRS rules. However, if approached properly, this strategy can supercharge tax-advantaged savings for those who are already maxing out their 401k. At Rhame and Gorrell Wealth Management, we provide advice on over $1 billion in client portfolios. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies that materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.